sellers understand how good of a time it is to sell. So it's beneficial for buyers because obviously they're securing a very low rate, but also for sellers, if you look at it from a purchasing power perspective. So let's do a loan amount of so at 2.5% interest rate, or let's say a buyer that qualifies for 350, or not qualifies, has a loan amount of 350 at 5.5%. If the rate dropped from 5.5 to 2.5, how much would that same buyer qualify for a loan now?
About 500,000. It's about a loan amount about 500,000. So you're looking at about almost a 50% increase in the buying power.
This is Joseluiz Morales. Welcome back to the Morales Group podcast. Today we've got a very special guest. It's a repeat offender. This is her third time on the show. Her name is Martha Salas. She works for Nations Lending. Today she's going to be covering things to know when refinancing and how the interest rate plays an effect on both purchasing power and also the real estate market. So welcome to the show, Martha. How are you?
I'm doing great. Thank you for having me on your show again, Jose Luiz.
Yeah, I know. Yeah. Well, I think this is a very important topic because essentially sometimes people don't realize the importance that the interest rate can have when they already have a property, how much they can actually save if they refinance. And sometimes sellers don't realize the advantage of how much more a buyer can afford now because of the lower interest rates as well too. So I think it's perfect timing for this, especially with the rates being so low at the present moment.
Indeed. And I was really so happy that you asked me to be on your show to talk about this very important topic right now and help our viewers.
Cool. So let's start off. Who determines the interest rate? Let's start off with that. And does the interest rate vary depending on any circumstances? For example, like credit score, down payment, and term of year. And if you could dig a little bit deep on that.
Sure. And the interest rate, well, first I'll start off by saying what an interest rate is. An interest rate is the cost of the money that one borrows. Okay. And the interest rate is managed by the Federal Reserve, okay? The banking system for the United States. And they manage your short-term interest rates, such as credit cards or HELOCs. Your long-term interest rates are impacted by a variety of factors, inflation, employment, things that happen around the world, also real estate sales, home sales. So a lot of things impact your long-term rates, mortgage rates. We follow the 10-year Treasury, okay? But normally they will follow in the same direction, the short-term and long-term rates. Now, to your second question in regards to FICO scores and how the credit worthiness of a borrower impacts an interest rate, or what they qualify for. And FICO scores are very, very important because this is how a bank will determine whether you're a good risk or not. Okay, but there's other factors. If you're going to live in the property, how much do you make, how much equity you have in the property, several factors are considered when reviewing a loan application. But certainly a FICO score is very important and something that the borrower has control over.
Okay. And what about the like term of the loan? Like sometimes people don't know that maybe like a shorter term actually benefits the interest rate? Does that create lower interest rates if it's a shorter term on the loan? Uh,
Yes, it does.
okay, so
Yes, your the shorter the term, the lower the rate. When your loan officer does an analysis
mhm,
for a refinance, especially if you've owned the home for a long time, or the last time that you refinance has been a while, you do want to look at a 20-year and a 15-year loan.
mhm.
And right now, I have had many borrowers come see me specifically for that reason, to cut the term on their loan.
Okay, and I'm imagining somebody has their interest rate now, that there's a possibility that with the lower rate, even at a shorter term, their payment could potentially be similar to what they have and almost like cut like a large portion of the years down. Because I remember growing up, my dad would always tell me these stories, and he would tell me like, yeah, like one of the best things that I ever did was I had a really high interest rate, the rates dropped, I refinanced, I didn't take any money out, I basically just decreased my rate and decreased them to like a 10-year loan. And he basically mentioned to me that the principals just started getting paid down really, really fast. And that
Yeah,
story always stuck with me like growing up, because I was like, okay, not only can you make money in real estate, like when you purchase it, but there's also ways to make money on the loan side if you actually understand the interest rates as well too, and you understand kind of how that dynamic works as well. Let me ask you this: what would be considered a good interest, or what would be considered a good credit score, and how much does it vary? Depending, how much does the interest rate vary? Are we talking about like if they have a really low credit score, does it vary like a percentage point, like a half of a percentage point? Like, does it?
it all depends.
Uh-huh.
Okay, you have different tiers that will where you can start really seeing an impact.
Hmm.
Okay, the company that I work for, we do consider loans at a very low FICO score. Now, what I would like to see is a FICO score over 700, and you start seeing tiers that your tiers running at 20, 720, 680, 700, 720, and so if someone's just shy of a certain FICO score, what we'll do is we'll look at their credit report and we'll see if there's some way that we could improve and get those extra points and give them a savings in their rate. That is the added value that you're looking for with your loan officer, is um, looking at every single way that you can possibly save money. And that's added with technology that's very much accessible in most mortgage companies, most loan officers. And also going back to the term and the savings, I like to present my borrowers with information the way that I like to receive it. I like to see it in black and white. And so instead of giving them an opinion, I tell them where the where their savings is. And so I'll do amortization schedules and we'll look at them. And this way that you could see in black, white, where the savings is and where they will see when it breaks even and when they start seeing the savings of refinancing at the new loan amount that factors in all the costs that you're going to have by refinancing. That gives the borrower a really sense of security. Any borrower that's well informed is going to sleep better and understand that the decisions that they're making are informed, and that's the way that I think it should be.
Yeah.
Given that respect.
Let me ask you this: does the interest rate vary based on what type of property it is? Like, for example,
Yes.
okay, how
Yeah,
so?
a condo versus a single family or units.
Hmm.
Okay, your lower rate you're going to see in a single family residence, and then you go to condo and then units.
Okay, and then so single family, condo, single. No wait, so it's
The lowest is a single family.
family, then the condo, then the unit is a little bit higher. Okay, Does it
Correct.
also vary based on the type of loan product? Like, for example, like FHA, conventional, VA, does the rate vary based on the loan product as well too?
Yes, it does. You will see a lower rate with FHA, but then you have to consider that you have mortgage insurance, but it's money well spent because you're only required to put 3.5% down. And so it also varies also with conventional, and there's different programs within
Mm.
each agency.
Yeah. And then for those listeners that don't know what mortgage insurance is, can you elaborate just slightly on that? And also, we did a program a long time ago with myself on one of my purchases that I didn't know, and not a lot of loan officers pitch it, but it was like a 10%, and I ended up buying out the mortgage insurance. So I didn't have to put 20% down. Can you elaborate just slightly on both of those things?
Yes, a bar has different options with respect
Uh-huh.
to mortgage insurance.
Mhm.
You can and it all depends how the market is pricing it out on
Uh-huh.
any given day. Okay, and we would compare this. You will first of all, you're required to pay mortgage insurance if you're putting less than 20% down. And like I said, it's money well spent because if you don't have 20%, then you still can buy a home with less money, as little as 3% down. Okay. Now you have the option to be able to not pay monthly mortgage insurance and pay a higher rate,
Mhm.
or pay a monthly mortgage insurance, okay,
Mhm.
or pay a lump sum.
Mhm.
Okay? Now, how do you choose which one best is the most economical or most beneficial to you? The math. And math has no emotions, no opinions. It will tell you in black and white which one is the most beneficial for you. Now, if you have a high FICO score, then many times you're able to get a super rate
Mhm.
and not have to pay uh, mortgage mortgage insurance monthly, and and just you. So we want that client, right? And
Yeah.
so we will go out of our way to engage that buyer. So, and it depends, like I said, how it's pricing out that day. So just ask your loan officer, please give me options of paying one lump sum, paying it monthly, or baking into the rate. And you'd have those three options, and you just choose which one is the cheapest for you.
So essentially, the rate varies by day. Essentially, it's something that is not like it changes every day. I'm imagining.
It changes all day long.
Yeah. Okay.
It could fluctuate. If it's a chaotic day and it's been an eventful day, it could change daily. I mean, all day long into the market closes.
So
But
what about when borrowers like who already have a loan receive that postcard in the mail, like 2.25% or 2%, then it's got that little star and then the fine print attached to it.
that's right. Yes, I recently got one, and it wasn't a fixed rate, and so um, if it sounds too good to be true, it's probably the case. And I always equate this scenario, this comparison.
Mhm.
If you have a 2021 Mercedes,
Mhm.
pretty much the price is set by the industry. Don't expect to go pay what I drive, pay for the Mercedes. Like, what do I drive? A Prius, right? That's not the way that it's not a bizarre type of atmosphere.
So let's get into Martha. Like, what are the different types of refinances? Because I don't think a lot of people know that there's different types of refinances. Obviously, we went over one already where you decrease the amount of years. That's one type of refinance. What are the other types of refinancing that somebody could do? And what are some of the reasons why somebody may want to refinance their mortgage?
Right. There's a variety of reasons. You're right. The most typical is the borrower that wants to lower their interest rate.
Uh-huh.
Okay. And then there's also borrowers who want to pull cash out,
Mm-hmm.
cash out
Mm-hmm.
refinances. And the interest rates vary from a rate, what is called a rate and term, no cash out, and a cash out interest rate. Okay. Mm-hmm. And a person would want to pull cash out. The most typical is to pay off debt. Mm-hmm. Or to do home improvements on their home.
Okay.
And I see in this last year and this year, I've seen a lot of borrowers do home improvements on their on their properties.
So basically do cash out refinance essentially to improve the property essentially. So essentially you've got someone that's wanting to maybe decrease the amount of years. That's one. You've got someone that wants to lower the interest rate, therefore lower their monthly payment. And then you've got somebody that maybe wants to take money out to either do a cash out refi. To either do home improvements or to pay off some debt in other words.
Yes, and student loans, I'm seeing that too.
Okay, where they're doing that. Okay, cool. And then like when somebody is refinancing like on an owner occupied property, what, like if you're taking money out, like is there a certain loan to value ratio that the bank would allow you to go to or no?
Yes, you go up to 80% to pull cash out.
Okay, up to 80%. And what that means is that the property is worth 100,000 basically, and you owe 40, you can take 40,000 up to the $80,000 mark, basically.
Right. Minus
it requires you to leave 20% of equity in the property. That therefore it's not like over leveraged or anything like that.
That's exactly right.
Okay, perfect. And then what's the difference between a fixed rate and then an adjustable loan? Like, and I think a lot of people are somewhat scared of adjustable loans just because of what happened in the last recession. But I'm imagining that those type of loans have a specific purpose and they serve certain people. Otherwise, they wouldn't exist. So what's the difference and what are the pros and cons of each one?
Okay. The fixed rate never changes.
Yeah.
Never ever changes until the loan is paid off. An adjustable rate mortgage will adjust at some point, and it will adjust anywhere every 6 months to stay fixed and until 10 years, up to 10 years. Okay. And I see adjustable rate loans when rates are higher. We don't even look at the fixed rate.
Really? Okay.
That's right, because it's beyond the borrower's reach at that point. And the payment is too high. And because an adjustable rate has these safety nets in place, they will not, jump dramatically from one point to another. Okay. Oftentimes, an adjustable rate mortgage is confused with the subprime loan, that instrument that almost destroyed the world years back. That's a completely different loan. An adjustable rate loan has been around and used for many, many years, and it's very useful. I also see an adjustable rate loan in your higher end communities. Because the rates, let's say that they're moderate, not what we have now, but you'll have people choose the adjustable because your loan amount is so high. Okay. And when we do an analysis, we've done analysis in the past. They said, no, I'll stay to my adjustable. It's where I feel comfortable. I'm not scared of it. So that's the difference between those two.
I think it also has to do with holding time, right? Like holding time, like how long do you plan on owning this property? Because it's really interesting, Martha, because my mind has changed over the years. I remember when I bought my first property, I was like, no, my dad always told me 30-year fixed, and I'm getting a 30-year fix. But then I ended up selling the property like 2 or 3 like 2 or 3 years later. And I thought to myself, could I potentially save some money, maybe improve the cash flow a little bit if I had done an adjustable loan on it instead of maybe tying myself up to like a 30-year fix. Not only that, but the rates have decreased tremendously as well too. Obviously, there was no way for me to forecast that, but I know that things change sometimes for people. And I think that people should ask themselves the question like, okay, what is my plan for this property? How long do I plan on holding on to this property? Is this something that I'm planning on holding on for less than 10 years, or is it something that I'm holding on to it for 30 years as well too, right?
That's exactly correct. Okay.
Uh-huh.
And particularly in with your condos.
Mm-hmm.
Okay? People don't hold on to condos for very long. Don't stay in condos for very long. They will build equity and move up to a single family. So that certainly is a conversation that should be had with your condo purchase and with any property, and just really give it some thought. How long do I plan on staying on the property?
And I think what you said was really good is that you get it fixed and then it becomes variable for a certain amount of time, right? Like meaning you can get it fixed for 5 years, then it becomes variable, or you can get it fixed for 10 years and then it becomes variable as well too. Are the rates, how much lower would you say that the rate is on a variable rate versus a fixed rate? And are the costs lower as well too to do a variable loan versus a fixed loan?
I haven't priced, to tell you the truth, I haven't priced an adjustable loan lately, because the people that I have mainly talked to in the last year or so have pretty much been focused on it really hasn't been an adjustable market, Jose Luis, in the last year and a half, for obvious reasons. I mean, historic low interest rates, but you can see a difference in normal times of 2% difference or more. Yeah,
It makes a big difference.
it does.
So if you're not planning on holding on to it for 30 years, potentially that might be an option for the consumer. So let's get into like purchasing power. This is, I think, one thing that people don't often realize right now. So I wanted to get into a couple different scenarios. So the first one I wanted to get into is, let's say that somebody's refinancing at a $500,000 loan amount, and they've got a 5.5% interest rate. What would approximately their PI, principal, interest, taxes, and insurance be? And then can you break it down how it changes from 5.5, 4.5, 3.5, and then 2.5, which is something that is potentially doable right now, just so that people can see the impact in the monthly payment that this has, essentially.
Right. It had now 5.5. That just puts us back to 2018, if you remember.
Not too long.
The latter part of 2018, we were at 5.5, right? So those people were the first ones in line when when we had this shift in the market. At 5.5 rate for a $500,000 loan, you're looking at about $2,800.
Okay.
30 something. And then to drop to a 2.5%, you're looking at about $1,900 a month.
So it's almost like $900 that somebody would be saving from a 5.5.
Yes.
2.5. So essentially, somebody bought their property in 2018. They likely got somewhere in the fives. Right now, for those people, you can virtually save almost $900 in that scenario, which is, I mean, to most families, I mean, that is a significant difference right there, right?
It is for any family. I think it's a huge saving, and people have taken advantage of this, and this just in trying times like this, I think it's the best thing that the government ever did, because it really put money in people's own pockets.
Yeah, absolutely. No, I'm a believer, and this helps out a lot of people. I just think that some people, I've talked to people that have a 5.5% interest rate. I'm just like, what are you doing? Like, go get the loan officer ASAP, because you're going to save hundreds of dollars on a monthly basis. So let's kind of reverse the situation. So this is almost like just so that sellers understand how good of a time it is to sell. So it's beneficial for buyers because obviously they're securing a very low rate, but also for sellers, if you look at it from a purchasing power perspective. So let's do a loan amount of so at 2.5% interest rate, or let's say a buyer that qualifies for 350, or not qualifies, has a loan amount of 350 at 5.5%. If the rate dropped from 5.5 to 2.5, how much would that same buyer qualify for a loan now?
About 500,000. It's about a loan amount about 500,000. So you're looking at about almost a 50% increase in the buying power.
So essentially
compare 2018
to now,
to now, yes.
So essentially, if we compare 2018 to now, the rates now, buyers approximately will qualify on a loan amount of 350 to 500 for an approximate $150,000 more. So their purchasing power went up by $150,000 more without changing anything. The only thing that changed was the interest rate.
Correct.
What that means for sellers is that buyers can afford more, which means they'll likely be able to pay more for the property, which is one of the reasons why I'm seeing like a unbelievable surge in demand and potentially multiple offers on a lot of properties as well too, you know. So it makes a big difference. Martha, is there anything else that we missed, or anything else that you feel that we should add as it relates to this topic?
The one advice that I always give my customers that call me and tell me that they're thinking about buying, don't make any major purchases. If you have the thought of buying a house, wait to make that purchase before you talk to your loan officer, and be very mindful of your credit. Make your payments on time. If you have cash at home, do not deposit it, okay, until you talk to your loan officer, and then do a budget. And just list everything that goes, out of you pay every month, and you'll be very surprised, but you'll come to your consultation more prepared, and you'll be surprised that you could afford to buy something, or to create a roadmap for the long term, but you'll have a goal and you'll have real numbers for you to work with and plan ahead.
Yeah, that's what I tell people. Like, a lot of times I talk to buyers that say, hey, I don't think I qualify for this reason, or I don't think I qualify for that reason. My recommendation, just meet with a loan officer. They're going to tell you exactly what needs to happen for you to be able to qualify. For me, every time I buy a property, my immediate call is to the loan officer again. Okay, what do I got to do to buy the next one? And they coach me and they tell me, okay, well, if you want to buy the next one, this is what you have to do. But it's always just good to know. Martha, where can people get a hold of you?
You can call me on my cell phone, 805-890-2008.
Perfect. So this is the Luis Morales show. This is the Morales Group show. This is episode number 48. We had Martha Salas with Nations Lending. If you've enjoyed this episode, please subscribe, like, and share this. It helps out the YouTube algorithm, and it helps me out tremendously. Also, there should be a couple of videos right here on the right-hand side. So if you've enjoyed this interview, you might want to check out some of our other interviews coming up. Thanks, Martha. I appreciate the time.
Thank you,
knowledge, and we'll stay in touch.
Okay. Bye-bye.